Cool. Well, welcome to the 2026 market update. We have a lineup of rock star speakers and presenters giving you quick hits. The idea of this is spend somewhere between 75 to 90 minutes in 5 minute increments, hitting on multiple different industries, multiple different verticals, giving you updates on kind of where we are currently with each one of these different industries and kind of what some of the expectations are for 2026. That being said, a lot of this could be speculative. A lot of it could be based on statistical analysis that has happened over the past 12 months and news and things that are in the tabloid or not tabloids, but like in the news about what could be coming in 2026. Um, Guys, there's a lot of stuff that's outside of our control. What I want you to do is focus on the controllables, right? Control the controllables. There are things inside of the realm of us doing business that we do control. And that is what you should really be focusing your time and your efforts on in 2026. So we're going to give you some indications, some ideas of what might be happening in the marketplace from everything from residential real estate, commercial real estate, residential financing, commercial financing. We'll be talking about raising capital and what the investor sentiment is out there, talking about taxes, insurance, accounting side of things, what the labor market looks like, what the trades market looks like, short-term rentals. Like we have a lot of really, really awesome topics lined up. So with that being said, get some notes out. Have a pen and paper, get ready because we're going to share a lot of information. So I'm going to open it up first off with my boy, Brian Manley. Brian, are you there, buddy?
What's going on? Good morning. Good morning.
What's up, buddy? How are you?
I'm good. I'm good. I'm good. Good to see you,
Good.
man.
So, dude, start us off. Let's get going. You look good for the new year, man. You look bright, shiny-eyed, and bushy-tailed, and excited, and looks like you got some optimism for 2026. Why don't you spend a couple minutes on what you're seeing in the marketplace? Any sort of quantifiable statistics or anything like that, man? I'd love to hear you share it. And
Uh,
let's get it rolling.
I do, and I love numbers and I love stats. So I am optimistic, and I'm glad that I don't look like a complete vampire. I tried some lighting in here, and I'm like,
You
let's see
look
how this
good, buddy.
goes. So, one of the first things that I want to talk about is just really about the hyper locality and the hyper local nature of what I'm seeing in real estate. So, for people who don't know in the background, I flip and wholesale houses and actually take them down, build all that kind of stuff all around the country. So, going on 120 plus cities right now. So I get a pretty good idea of what's going on around the country because I operate in all these different markets. So one of the things I'm seeing right now is Southeast. One thing that people have really getting hit with and not considering is just energy costs, rising energy costs, and of course insurances. So what I'm seeing is even projects I've got six in the market right now in one particular market, and I'm seeing drops across. So Southeast is not blossoming the way it was, right? For example, every single project, the last six or seven in North Carolina have all taken price cuts. And that's pretty much in alignment with what we're seeing here, but it's not doom or gloom. So perfect stat for that, like price cuts last week. And you have to be careful with weeks because it's volatility. A week is such a small sample size, but we saw 34%, 34.7% price cuts last week. Same time last year was 34%, right?
That's
So
number of price cuts on total houses in the marketplace.
yeah,
34 of them cut their prices last week.
correct,
Yeah.
correct. And if you overlay that to the year before, the number's almost identical at 34%, right? But what we are seeing for the first time in a long time is that you've got more homes with their interest rates that are below or that are above 6% than below, right? And that was
Mm-hmm.
kind of this magic thing. So it's close, 21.2% is above six, 20% is below that three. So what it looks like is that thing where people were just locked in and weren't willing to give up those rates. We're now starting to see just life is happening. So people are moving, migrating, and they're going to versus now everybody's going down to the southeast. What you're seeing now is people are going to Midwest, Northeast, which is an area I didn't really do a lot of investing in. But you're seeing price increases, for example, like Western Pennsylvania, the price cash buyers have gone from 3% of the markets in one of the towns there, Jonestown, to 32% in 1 year. So you're seeing,
Wow.
you're seeing investor activity really, really, really pick up. I think investors bought something like 30% of the homes last year. And with those homes being bought, it's not the big institutions that everybody's worried about. It's guys like, I hate to say guys like me, but it's
Well,
it's all the absorption is coming from that investor.
something that's big in the news is Trump's tweet last week or whatever of saying, "Hey, we're going to stop all institutional hedge funds from buying single family houses." Now, I haven't dove into this, but I just had coffee with a good friend of mine who flips 500 houses a year just this morning, and came directly here. One of the things that he mentioned while we were sitting down is like 95% of single family investment property, 95% of single family investment property are owned by individuals like small mom and pop investors like us. Only
Yeah.
5% is actually owned by the big institutional investors. So, it could be just kind of like an optics thing that he's trying to play,
100%. I mean, it's you know what? I mean, it's a great visual. It's great great for optics, right? And
but it
when you
wouldn't
convey
really
that.
move the market in one way or another, right?
No, my only thing with that is because you have the consistency, right? Like the big companies have consistency, even if they're buying 2 to 5% per year. If they continue to do that long term, then that can look very, very different because there's endless cash there. So the
Mm-hmm.
compounding effect of that there. But when we're talking about short term, what's really driving the market, what's making a difference, it's not the institutions that's driving that. And we all kind of feel and sense that if we've lost a deal to a big institution, and we're like, they're taking up everything. But
Well,
really,
they're very market specific, right? Like
100%.
Phoenix, dude, that's where you're at. Dude, they bought a lot of, and they're very, very heavy and condensed in certain marketplaces.
Yeah.
But balancing it out over the course of the entire country, it's smaller. I see a comment here, somebody saying that it's because they're gearing up to buy a bunch of property across the market, more or less than what they've done in the past. I don't know.
Well, so I don't know if it's necessarily gearing up. I do know that as you start to see some thawing out, you certainly smart money was not going out and trying to catch a falling knife, right? But I will say the majority of when you talk about how targeted they are, so I made a note here actually interesting of that. Investor ownership is concentrated in a handful of states. You got Texas, California, Florida, North Carolina, and Georgia. And we like to say Phoenix. It's not statewide like all of
Yeah,
Arizona, but
yeah.
it's Phoenix. It's the Phoenix metro area. But a lot of the big investors, and I suspect a lot of that what you see is because you've got newer homes, you've got cookie cutter. It's easy to run them. It's easy to comp them. It's easy to build out. Cities like Phoenix should continue to build out and people can go out wide. So there's a lot that comes into play. What's surprising though, with all things except for um, like geographically, I'm seeing price drops all over. All over. There's a really, really good tool that I like to use called what's it here? I put it out here and it's dropping. It is God, hold on, I have it open here. I'll give it to you guys before I go here. But it's a tool that I use that takes a look at the amount of uh, by zip code. It gives you a map of where zips and by counties, where they're dropping, where prices. And you can kind of look and see this migration of where things are going. And like a lot of my honeypots are not the places where you're making deals anymore.
Hmm.
But I don't know if it's necessarily that the institutions are just gearing up as they're just being smart and waiting as you see people willing to trade. And it's the same thing a few years ago, I was flipping houses. And as prices were climbing, people would have an idea of what they thought they can get for $450,000, and they were really, 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 really slow to adopt and say, "I'm going to take this $450,000 house." And then they finally caught up 6 months later. What we're now starting to see is people going, "I'm not giving up my interest rate." And you see that trade-off where now the threes and the sixes, because babies still get born, jobs still happen, deaths still happen. And so we're starting to see now people are getting used to it. But the buyer does understand that they have a lot more options. So again, everything that I've put out in the past 6 months, almost everything universally, we've had to take probably 10% less than what we originally projected. So
Hmm.
that's still mindful. I've seen things drop as quickly as we bought it in September. Comps were outstanding September and October. 10 to 15% price drop in January. So,
So let's close out with this. What is moving? What is moving at the price points that you thought it would be moving at?
so what's interesting is higher. So 600,000 and above, still moving pretty quick, right? What people are doing is very, very interesting. Is they're not just buying it at comp. What they're doing at that price point, because those people obviously have different financing limitations, is they're taking these homes and they're over improving and not just comping to the 700,000 they'd be worth, but taking them to 800, $900,000 by really, really, really tricking them out. The stuff that's between 100 and 250, it's still moving, but those people are a lot more price sensitive. So what you're doing now is those people are considering energy costs. Again, I saw an $1,000 energy bill. And so you're really, really having to be sensitive there. They'll move. I've got one that we just dropped it. We were dropping it every 2 weeks. As soon as it hit the right number, 3 days later, it had a contract. So we thought we would get 215 for it. As soon as it hit the 190 mark, 3 days, boom, it was a frenzy. So the markets will tell you what to do. What I'd advise people not to do is try to be the guy that waits it out, thinking that it's going to come back and your buyer doesn't know. They're more sophisticated than ever. And it's not like they're not going to know there are 15 other options that are comparable to yours. So get in and get out and be quick. But those are the starters. The middle in between 250 and 600. That's potluck based on where you are.
Love it, dude. Great insights. I appreciate you being here, Brian. Let's move over into commercial real estate. So that's Kate, by the way. Um, let's move into commercial real estate. So we got Dan Costantino here. Dan owns about 600 doors out of the Pittsburgh market and has been in the commercial real estate and multifamily space for a while. So Dan, tell me what you're seeing, brother.
Well, we no longer own over 600 units because we sold 152, which was a big reset for us. We freed up a ton of capital, like 4.6 million in capital. So we learned a lot through that process. We learned a lot with talking with the brokers. So there are buyers, and we're working with Colliers right now, and they're connecting us with some pretty big, buying groups around the country. There is appetite for, Class C value add still.
Dude, I've seen
Um,
it. I've seen it. It's been taken up pretty consistently. Like we've gotten a lot of phone calls, a lot of emails from both brokers and buyers over the course of the past just 2 weeks. So there's a lot of positive sentiment that we're seeing too.
I think we'll learn more this year. We 2026 is I heard the term harvest, a harvest year. So I feel like that's what that is for us with our projects nearing full cycle. Um, but why we're able to do that right now is number one, we've been really successful holding and improving our rent rates. You know, 2 years ago when we were in the 70s on occupancy, we were happy to have those $800, $900 tenants. We still have those guys, but now we're at 97% occupancy. We're moving people up to 1150. We're getting $300 rent increases and they're
Wow.
staying. We really thought that they were going to move out at a greater clip and we were going to have to renovate, which we're in position to do. But our rent rates are actually holding, which I've been pretty
Well,
surprised by.
dude, everything that I've been reading statistically regarding rents have been, countrywide pretty flat nationally over the past few years, but it's showing that like everything consistently, everything that I read, everybody I talk to on, publicly traded companies and big high up executives that I know, everybody says the rent bumps are going to start coming back and you're going to see rent growth of somewhere between 3 to 4% industry, like across the nation. Um, uh, Standard between now and the end of the decade.
A lot of people are testing the market and they're saying, I'm going to go buy. And when they go get their quotes, their term sheets, they find out that renting is still affordable. At least
Mm-hmm.
in our Class C stuff. We've started to buy some Class B stuff where it's, 15 to $1,800 a door. But most of our portfolio is in that, 1,000 to 1,200, which is a different tenant, by the way, in our market
Well,
in
that's
Pittsburgh.
struggled pretty considerably over the past 36 months, right? That's C class 70s vintage type of
Mhm.
apartments. You're buying it for a low price point per door, but it's been like very, very difficult because it's hard to manage, right? There's a lot of turnover, a lot more turnover in that space. Do you see opportunities in that over the course of the next 12 to 36 months?
I do, but you've just got to be creative on the capital stack. We do have a couple properties listed. One's a 36 and the other's an 18, and we're selling them together because we have them on a loan. You get a lot of people that come to you with owner financing and things of that nature. So, I don't see great cap rates. Like, when we acquired these things were trading in the sixes. I don't see that right now. Sevens
Yep.
and really into the eights, is realistic if you want something to move. You can list it for whatever you want, but what I think can get some things done, I think you have to be a little more realistic on the cap rates.
No, I agree. I agree. I'm watching the comments too, and someone mentioned ice raids. Absolutely. Like we have a building in Houston that was at
Mhm.
94% occupancy, and it's down to like the mid 80s now. Um, all because of the ICE raids, just scaring the heck out of anybody, like the showings. There were a bunch of people who got placed that we thought were, it's all third-party management, but they get underwritten, they get screened, they get checked, their credit check and all that kind of stuff. And they had social security numbers, right? And or international tax ID numbers kind of thing. And they were just given out to people who weren't American citizens back in the last administration. And so now people that we thought were, American citizens who had jobs and all this stuff now are they're scared. They won't even open the doors for maintenance division and stuff like that. It's really impacted, especially like Houston's a big Hispanic market. So it's impacted our market down there pretty considerably. Are you guys seeing that in Houston or in Pittsburgh?
I hear it because we have some tenants that are Hispanic from Cuba and they tell us, I mean, they speak Spanish primarily, and they tell us that there's some concern there. But we haven't had any tenants that we've lost, because of that, thankfully. Interestingly enough, I mean, new construction is still a big driver, I think, for rentals being on the increase because I'm invested in land that sells out to these big developers, and the big developers are really bending the land people over right now and pulling out of deals and giving land back or canceling contracts, and that's just going to slow down the new construction of new units, and it's going to, I think, really force people to rent for longer than
Well,
anticipated.
well, you bring up a really good point, man, because depending on the reports you read, somewhere between 3.7 to 4.5 million housing units short in the United States right now. We also need another million per year in order to keep up with population growth and from people coming of age, immigrants, and all that kind of stuff. But builders, to your point, have been pencils down for the past 3 years because they get loans. Construction financing is based on the short-term Fed funds rate. And so when rates were going like this, there's been a lot of deliveries over the past 3 years because those projects started in 2020, 2021, 2022, and they're delivered 24 to 36 months later. So you've seen deliveries in 23, 24, and 25, even though rates have gone like this, but there's no new starts, right? And so there's no deliveries in 26, 27, 28, which tells you you're going to be 7 million housing units short in the next 36 months. The other thing is 45% of all commercial multifamily loans mature over the next 36 months. So almost half of all loans will be coming due. And that's one of these things that not a lot of people are talking about right now. What does that look like for people to be able to refinance? Will they be able to refinance? Will they be able to refinance at the same level of debt that they currently have? Or are they going to have to write a check in order to put new debt in place? So
Well,
it'll
we're in
be,
that boat. We're in that boat, Tim. I mean, we have a 5-year rate reset that's due to mature or not to reset at the end of the year, and we're at 3.25%. Thankfully, we've been really good on our value add, and most of our buildings were 2x on the rent rates, or the gross rents than what we took over. So we can afford a rate reset now, thankfully. And I am seeing, last year we had a refi of I think 7.2, maybe early in the year, and now I'm getting rates at 6.5. So I mean, rates are definitely coming down, and if you get agency debt, you can get even lower. So hopefully people are okay, but I know you see true commercial office, you know, uh, the vacancy so high that $100 million buildings are now foreclosed on and selling for 40 million right in downtown
well, I
Pittsburgh.
mean, that's, I think there's going to be a big play between now and the end of the decade of the C-class stuff, the vintage 70s vintage stuff that, by the way, is some of the best located properties in
Mhm.
towns, right? They're close to urban areas, they're walkable to everything. They're in that first ring suburb or in the urban area, the urban centers of these towns. And guess what, dude? You can't build for what you can buy these things for. So there's zero, and anything that does come on new construction wise between now and the end of the decade is all going to be luxury, right? You can't build a multifamily apartment complex for less than 150, $175,000 a door. And so there's none of that product coming on. So if you can go and buy in the Midwest and Southeast, Great Plains, Texas, whatever, for 50, 60, 70, 80, 90, 100,000, 120,000 a door. And they're surrounded by houses that, median house price is 450 or $500,000. Dude, it's like, this is the best option. I think there's going to be a big play on condo conversions. We
Yeah.
haven't talked about
We've
this
considered
in
it.
20 years. We're
Mhm.
looking at doing it a lot with several of our like townhome style apartments of doing a condo conversion, right?
Yep.
And taking something that we could at best sell for $80,000 a door to an investor, we'll now be able to sell it to the tenant for $120,000 a door. They couldn't find something that they could own for anywhere in that price point. The cities are going to love it because they want more home ownership. It creates more stability in the community, and you literally can't build this stuff for what you could buy it, renovate it, and then sell it for as a condo conversion. So I think there's going to be a play there.
Absolutely.
Awesome, brother. Thank you for being here.